being between rent prices and what it is to pay a mortgage, that margin is starting to decrease.
It is, and rents here, especially in South Florida, have been historically high.
Correct.
Like historically high right now. And then in only certain cases is it actually cheaper to rent. It's almost better to buy in any situation.
Well, if somebody's paying rent, they should buy. It doesn't matter if the interest rate is 5%, or in the 5% range as they are right now, or 9%.
Hey everybody, how you doing? David Kurz here. As always, every Thursday at 4 p.m., we do the Kurz Real Estate Show for you. You can find us at KurzRE.com. That's KURZRE.com. Or you can call our office at 786-529-5273. We'll give a special shout out to our partners on this show, New World Title, Caliber Home Loans, and Max Home Inspections. Thank you for being a continuous part of our success at Kurz Real Estate. Speaking of Caliber Home Loans, I have Mike Ortiz with me today, who is our in-house lender and a proud member of Caliber Home Loans. Thank you, sir.
Thank you for having me.
Coming on the show. I appreciate it. So today we're going to talk about, usually I'm like, hey, today we're going to have a really cool conversation, but no, we're not. We're going to talk about...
As soon as mortgages is involved, it's
not
cool anymore.
Yeah, that's it, man. So we're going to talk about rising interest rates. We're going to talk about, I want to make up a word here, buyability, right? So buyer's ability to purchase, right? We're going to talk about credit right now. We're going to talk about new loan programs. We're going to have a little bit of a fun conversation because as you're very well aware, and if you're even paying attention, the market is going through significant change right now. So, and with that significant change comes a huge change in lending and a huge change in buyer ability or buyability.
Buyability.
I just made that up.
Yeah, buyability.
Awesome. We're going to hashtag that. We're going to coin it. We're going to phrase it. Don't be stealing my stuff out there, ladies and gentlemen. So anyway, like I said, I'm David Kurz, Kurz Real Estate. You can follow me directly by going to davidkurz360.com. That's David, Kurz, 360.com. From there, you have access to all our company pages, company social media, as well as personal pages and personal social media. So follow me, like it, share it. I would love for you guys watching this show right now to click that little share button on the lower right-hand corner and share it out with people because the conversation we're going to have today affects every single one of us. And when I say every single one of us, I literally mean everyone in the real estate transaction. The buyer, the seller, the lender, the agent, the title company, the inspector. Everyone's going to be affected over the next... I would venture to say, people think it's going to come a lot quicker. I don't think it's going to come as quick as 3 months, but I'm saying over the next 6 to 12 to maybe 18 months, there's going to be a steady shift happening in the market.
Indeed. What we're seeing right now is a lot of volatility in the interest rate market as a whole. So once you start seeing that volatility and a rising rate market, you're gonna go through phases before we hit a plateau where people understand the market. And the reason that the customer knowledge needs to be made and the customer awareness needs to be increased because, for example, last week, I think it was Wednesday, we had a 0.25% interest rate hike in one day.
That's insane. Right?
That's insane, a 0.25%.
So that meant basically, so I want everybody to understand this. That morning, Mike woke up and he gave out a bunch of pre-approvals. And he basically said, okay, you approve for this, you approve for that, you approve for this, you approve for that. And by that afternoon, he could not offer those same approvals. He couldn't, and he couldn't stand by what he had sent this morning.
Correct. Because the market that influences mortgage rates is very similar to a stock market. So it trades live, and different things that take place throughout the world. There's so many factors that influence it. Affect this market, and then when this market is affected, and when there's a downturn in this market, it in turn affects interest rates directly. There's a huge misconception in the industry that people think interest rates are increased when the Fed changes the rates. When you hear Feds increase interest rates by 0.25%, people are under the assumption that housing rates have increased by 0.25%, when that's not correct at all. when the Fed increases interest rates, that is affecting short-term rates, such as credit cards and revolving debt. Home equity line of credits are affected when the Fed increases interest rates, but car loans, credit cards, those are the rates that are affected when the Fed increases interest rates. It's not mortgage rates directly. So those factors now in the economy that we're entering is a good economy. So, when the economy does well, interest rates tend to do poorly or perform poorly. And the reason is because there's billions of dollars moving over from what is considered a safe haven for investors. Mortgage-backed securities is considered a safe haven because it's usually not very volatile.
Right.
So what happens is that when the economy is doing well, money in the trillions moves from the safe haven that is mortgage-backed securities into the stock market, and people take advantage of the increases that the stock market is having right now. And when the stock market decreases, sometimes, not always, we do see mortgage-backed securities improve, and then mortgage interest rates decrease.
So now let's get into nuts and bolts, right? Interest rates are on the rise.
Yes.
So right now, as of today, what are they basically?
Well, it depends on the specifics, but for example, for a 20% down payment, almost 800 credit score, I just quoted a 4.95%. So,
which is really good, right?
Which is excellent. I mean,
So
it still makes money extremely cheap.
So give me FHA 650 credit score.
It's going to be about a 5.5.
5.5 interest rate.
Correct. 5.25 to 5.5.
Now, what really trips me out is the people who complain about this.
Oh, yeah.
Right?
Those are the ones
Which
that
really trips me out. And look, if you're a buyer out there and you're looking 5.5 and yesterday it was 5.25, well, look, not to sound like a jerk, but you should have bought a house yesterday if that was the case, right?
Right.
Or last year when it was 4.5%. Right?
Correct.
And it's going to continue to rise. It's going to continue to change. There were points where the United States had interest rates at 11 to 13%,
Indeed.
and still people were buying homes, right? But at that time, you could imagine that homes weren't extremely expensive, but mortgages were.
Correct.
Right? And so with that note, let's talk about pricing. So with interest rates on the rise, pricing has to make an adjustment, right?
Of course.
So pricing, so you guys understand, as interest rates rise, buyability becomes an issue, right? Because the person who is really on a debt-to-income where it's pretty tight and they can only afford X amount of dollars a month, now half a point higher, their payment jumps a couple $100 higher or whatever the case is, and now it puts them out of range of being able to purchase at that price point. Therefore, they now qualify for less, right? And when they qualify for less, it becomes harder for them to find a home to purchase. And if it becomes harder for them to find a home to purchase, and this happens enough, then sellers end up on the market for a longer period of time, waiting for the magic buyer to come out of anywhere, right?
Correct.
And then when they realize that the property is not going to move because there's no one who can afford their property or no one that's willing to pay the price for that property, then prices begin to make an adjustment. Mm-hmm. So today I saw somebody post and they said, prediction, prices will drop by 30%.
Really?
Yeah.
That's a bold prediction.
That's a very, very bold prediction. We really don't see that happening. Now,
at all.
Will prices drop some? Yes, they will.
I think I don't know if we're going to see them actually drop. I think for now what we're going to see is a slowdown in the rapid appreciation that has been taking place.
Right.
So recently, we've been seeing appreciation move quite fast, right?
But appreciation comes from purchasing at certain prices. Right?
Correct.
So prices are, what you're suggesting is that prices will steady out.
Will steady out. And over the history of real estate, since they've been metering appreciation here in the state of Florida, even with the downturn of 2007, the average is about a 4 to 5%. Somewhere in between there, I don't know the exact number, but it's about a 4 to 5% appreciation rate per year. Over the last couple of years, we've seen probably double that, and in some areas triple, and if not more than that per year. So we've seen properties increase 15%, 20% appreciation as the market has been increasing. And the reason that took place is because what David calls buyability, the buyability was very low. So people could afford a much more expensive home because interest rates were in the 3s, 4% range. Now the prices went up, interest rates are going up, Now, what we call affordability is shrinking. So that margin of being between rent prices and what it is to pay a mortgage, that margin is starting to decrease.
It is, and rents here, especially in South Florida, have been historically high.
Correct.
Like historically high right now. And then in only certain cases is it actually cheaper to rent. It's almost better to buy in any situation.
Well, if somebody's paying rent, they should buy. It doesn't matter if the interest rate is 5%, or in the 5% range as they are right now, or 9%. I've shown this to customers very often, where the benefits of purchasing a home, tax benefits, the fact of creating equity by appreciation and by paying down the principal on the loan that you have on the property, outweigh renting any day of the week.
Right. Right.
So regardless of interest rates, buying over is still better than renting.
Okay. So now that we've made certain things clear, interest rates will continue to rise.
Indeed.
Prices will plateau, in my opinion, will come down some.
Correct.
I know you say plateau. I'm telling you, in my opinion, what I've been looking at, prices will come down. Will there be a slowdown in the market? That's another question, right? But that's all a part of the process. So people are starting to see now that less houses are moving on a month-by-month basis, right? So let's say June, X amount of houses sold, July, X amount of and then August has slowed down, and then September there were less houses that closed. Correct. And now we're in October, and we're seeing another slowdown in purchases. So this is happening because of what we're talking about. Volatile interest rate rise, right? But maintaining a high price.
Correct.
So this is all a part of the system, guys. This is how it happens. And what you're going to see over the next few months is prices will start to decrease some so that sellers can meet buyers somewhere. Because buyers' interest rates are going up. Prices are starting to decrease some. They've got to meet somewhere, right? And so being able to meet together is when the units will start moving again. Houses will start selling at a normal rate. The problem is that if you've been in the business for anything less than, I would say, 5 or 6 years, you don't know what normal rate is.
At all.
Right?
You just know historically low rate market.
Yeah. So you don't know what a normal interest rate is. You don't know what a normal rate of sale is. You don't know what a normal day on market is. You don't know what a normal effort it takes to sell a house anymore. And what will begin to happen is you will see a lot of real estate agents and mortgage professionals phasing out of the business.
Overdue.
A lot of title companies will be shutting their doors.
Yep.
Right? A lot of inspection companies will be closing down.
Mm-hmm.
Right? And this is basically all due to people who are accustomed to this steady rise. Like prices keep going up, people keep buying.
Yep.
Sellers keep selling. It's a fantastic world we live in, and it's been 10 years.
Yeah.
We've
It's been 10 years of historically of the lowest interest rates that have ever existed in the mortgage industry.
Right.
Ever. And we're still in historically low rate markets as we speak right now. So people hear 5 and they say, I'm going to wait till the interest rates go down. Well, here's the news. Here's my prediction on that. I don't think interest rates will go below 5% again in my lifetime. There it is. It's a bold prediction. And the reason for that is because what took for interest rates to drop below 5% was a cataclysmic event, basically.
Right.
It was a great recession. That's what they called it. That's what they coined it. And it was practically a depression.
So think about the Great Recession, and we're talking like 2005, 6, 7, 8, like that whole progression, right? It took 10 to 15 years to get to that. Then we had the bubble pop, right? And then we had about 4 years of that. Then we had another couple years of REO market and this and that, and short sales, and people who were sitting in their houses for 2 years not paying mortgage, and then it turned into an REO or short sale, and then these things were happening like I did 60 short sales in 1 year once, right? And so then it normalized. But then what happens? New programs started to come out. One day out of bankruptcy, we got you. One day out of short sale, we got you. One day out of foreclosure, we got you. And that was, it basically, it was 1 year out or 2 years out, oh, we'll take care of you. 1 year, we'll take care of you. 6 months, we'll take care of you. 1 day, we'll take care of you. So all these new products begin to come out to entice more buyers to purchase homes because let's be real, home sales and the real estate market really, really runs the country. The movement of money in real estate is what keeps this country really rotating and moving.
Correct.
Right? So if you have too many people defaulting, banks suffer, jobs suffer, everything suffers, right? So that being said, I would also tell you that for everyone who's going, oh my God, we're going to crash right now, this is some bullshit, right? For everyone thinking that, no, we're not. It's going to normalize. However, the mortgage industry will come out with some really amazing products for buyers out there. Mark my word. Interest rates, again, his feeling is never below 5 again in his lifetime. He could be very right, okay? Because like I was going through the timeline, we're going to have another 10 to 15 years of this, what we're going through.
Absolutely.
Right?
Absolutely.
And then 15 years from now, who knows what's going to happen?
We
right?
don't know.
Who knows what's going to happen? So my point is that rest assured that things will happen to ensure the movement of money in real estate.
Indeed.
All you have to do is track it, follow it. Now, if you're a buyer or seller, you're tracking this very differently than an agent or lender, right?
Absolutely.
If you're a buyer or seller, if you're selling, now's probably the right time to sell. If you're a buyer, now's the right time to buy. Last year was an even better time to buy. The year before that was even more fantastic, right?
Indeed.
But now is the time to get into a house because next year it will cost you more to borrow that money. And so basically you'll be paying more for dollars.
Correct.
And so you're going to get less home for more money.
Correct.
Less home for a bigger monthly nut, right?
Correct.
And so for those of you looking to buy, right now is the time. If you're looking to sell, right now is the time. And really get out there and really aggressively market your home with the right real estate professional, right? So let me get to that side of the coin. Lenders and realtors really need to pay attention to this market and see what they need to do to ensure that the relationships that they have are strong. Mark my words that the real estate professionals out there that do not have strong real estate relationships, they don't have strong relationships like the one that we have, or they don't have strong relationships with their agents or their colleagues or their partners, and more importantly, their past clients, their clients now, the leads that they work with, the restaurants they go to, the barber they visit, the stylist they visit. Like, all of these people need to be very strong relationships, and they need to feel like there's absolutely no one else in the world that they would rather refer real estate to. If you can accomplish that over the next 6 to 18 months, if you can just focus on building relationships and relationships only, you'll make it through this industry.
Oh, indeed.
And you'll continue to sell houses.
It's going to separate the men from the boys.
Right. For theoretical...
For theoretical purposes.
And we're going to see the numbers drop dramatically. We're going to see 55,000 real estate agents. I believe that in the next 12 to 18 months, we're down to 25,000 again.
I'll piggyback with you on that because the memberships for the associations
cost money.
It
costs money to maintain the license.
Correct. And if you're doing one transaction a year or 2 transactions a year, it's not going to be worth to renew. So, but one thing that people need to understand, and what realtors need to understand, so that they can communicate this to buyers, is that the people that do not pay for a home in cash need to focus on the fact that we are still in a historically low rate market. So if prices do decrease by 10%, let's say on a $450,000 house, that's $45,000. What $45,000 does to a mortgage over 30 years is very little. It may increase the payment by $100 to $150, or decrease the payment by $100 to $150 a month. But if interest rates increase by 1%, while the market decreases, or let's say values decrease by 10%, you're still going to be paying more on a monthly basis on a mortgage for a property that you paid 10% less than what it costs in this market. And the reason is because interest rates impact the payment and influence the payment much more than the purchase price does, because that's spread over 30 years.
I oftentimes had this conversation with buyers when I worked with a lot of buyers. I would ask, what's more important to you, the purchase price of the home or what you keep in the bank every month? Right? What's more important to you? Because when you sat down with me, we were talking about a monthly budget.
Correct.
And you said, my monthly budget is X, Y, Z. And now you're looking at the price of the house, you're saying, oh, I can't pay that much for a house.
Correct.
Why not? It appraises with the loan and the interest rate and everything you're getting, you're at or beneath your budget for the home purchase.
Then it makes sense.
So I don't understand,
Yeah.
right? And so what most people can't separate is the purchase price of the home and the actual interest rate that influences the monthly payment. So the advice that you're getting today is phenomenal. So, and if you're a buyer out there and you're listening to our show, we're still in historically low rates. He said it himself right now. They're just going to continue to go up. So do yourself a favor, Mr. and Mrs. Buyer. Call us, 786-529-5273. Come talk to us about purchasing your future home that you're going to live in for, God willing, forever. I hope you do, okay? So, great show. Thank you for being on the show.
No problem.
How can everybody get in contact with you?
You can find me on Instagram at MortgageMikee. So that's Mike with 2 E's at the end. I'm also on Twitter under the same handle, MortgageMike with 2 E's at the end.
That's not Magic Mike. It's
No,
Mortgage
Mike.
Mike.
Yeah, Magic Mike is the other one. That's my cousin. Magic Mike is my cousin. I'm Mortgage Mike. You could also find us on Instagram and Facebook at the MD Mortgage Team. That's the team that I run at Caliber Home Loans along with Danny Agagarin. So, yeah, follow us. We're going to have a lot of great content coming your way soon. We're going to have a lot of strategies on how to battle this rising rate market, negotiation strategies that your sellers and buyers could use to overcome this rising rate market and to obtain and be able to afford a higher mortgage or a higher purchase price with some negotiation strategies that we've put together. I don't want to say too much because some of these things are industry secrets, but reach out to me and we could go ahead and sit down and talk on a one-on-one basis.
And let me say something. If you're a buyer, a seller, a realtor, or whatever the case is, and this entire conversation sounded like Chinese to you, just call us.
Absolutely.
Call us, come in, let's sit down, let's talk about it, and we'll break it down for you so that you can better understand what buying power there is right now and what selling power there is right now, which is important to all of our businesses. So visit us, kurzre.com, that's KURZRE.com. Follow us on Instagram, Facebook, at Kurz Real Estate, that's KURZ Real Estate. Follow me on Instagram or Facebook at David Adam Kurz. And that's all I can tell you, ladies and gentlemen. I appreciate you guys watching the show. I hope that this was amazing, beneficial information. I do want to give a special shout-out to Michelle Barnes, Alan Nikoff, Gloria Packingham, and Tangela Goa. Thank you for joining Kurz Real Estate, becoming a huge part of the family. We appreciate you very much. You've got our in-house lender, official introduction to you. And we're very happy to have you a part of the Kurz family. If you're looking to make a move and you would like to join the movement at Kurz Real Estate, all you got to do is go to joinkurzre.com. That's joinkurzre.com. You'll learn about us, submit an inquiry. We'll give you a call, set an appointment, and I promise you, you're going to love what we bring to the table. Talk to you guys soon. Have a fantastic day.